Hello, Vedavia community. My name is Hammer, and I am here with your mortgage rate market update. Today is February 7th, 2024. Let's go ahead and dive in and take a look and see what's going on with the mortgage market for you. Let me go ahead and pop this back up. So we do this each and every week, letting you know what's going on with rates, giving you a neutral place to just get your head wrapped around where we're at. If you have any questions, I'd love to hear them. If you're here live, say good morning. Let us know that you're here. If you'd like to be a part of the conversation, go ahead and comment in the question in the post and ask any questions or share your thoughts. If you're watching on the replay, go ahead and give us a hashtag replay in the comments. We do monitor the post, so go ahead and ask any questions or share any thoughts that you do have. So let's get to it, and let's talk about mortgage rates today, February 7th, 2024. Now, remember, this is not an offer to lend, and when we talk about rates, we're talking about averages and generalities. However, the last week, right? What happened last week, rates improved Tuesday, Wednesday, Thursday. We had a Fed meeting. And in that Fed meeting, Fed Chair Jerome Powell, in his press conference afterwards, actually gave a lot of hope to markets that the Fed is ready to start cutting rates. Now, we have seen Fed rate hikes since March of 2022. All right. So we saw months and months and months of Fed rate hikes. Now, the Fed doesn't set mortgage rates, but when they go ahead and they manipulate their policy rate, that does basically influence all the rates in the market: savings accounts, CDs, your home equity lines of credit, mortgage rates, car loans, student loans, credit card debt, credit card interest rates, all of those affected by this Fed policy rate. As the Fed raised that rate, they were raising the rate to slow down inflation. They wanted to make things more expensive to buy. They wanted to slow the pace of money. What that does is it brings the demand down and allows it to normalize, and we get a more stable economy and less inflation. And that's what's happened over the last couple of years. We had that huge increase in inflation after the pandemic. So up through last week, we had the Fed meeting, and things were going really well for mortgage rates. They were improving, some of the best rates we'd seen in quite a while. And then, boom, on Friday, we got jobs data. And I warned you last week that we were going to get this jobs data, and jobs data has a very big effect on mortgage rates. And the reason for that is that the Fed has a mandate to do two things. The first thing that they do is they need to go ahead and they need to keep inflation at or around 2%. That's a strong, healthy, growing economy. The second mandate is to keep the unemployment down, to keep labor markets full, and to keep employment up. So last Friday, we got a labor report that came in more than double what was expected. And on Friday, the particular data we were looking at was how many new non-farm jobs were created. How many new jobs are created in the economy? A strong, growing economy is going to require lots of people to work in it, and it creates new jobs. When job creation starts to fall, that's signs of a slowing economy. Well, we were expecting around 170 to 180,000 new non-farm jobs to be created. Guess how many came in? 353,000. Now, that is almost double what was expected. But here's the twist. This is not data that is just collected. It's collected and adjusted. And they adjusted what they call seasonal adjustments. And they made a seasonal adjustment. They made a change to how they do that for this reading last week. And that is why we believe that we saw such a strong number of jobs created that weren't expected. But what that did is it really slowed down the idea that the Fed will need to cut rates at their next meeting in March. So we had a meeting last week. That was the January meeting, the first meeting of the year. The Fed left their Fed policy rate unchanged. That was what was expected. That was actually not good or bad for mortgage rates. It kind of was right in line with what we expected. But again, at that policy conference, the press conference rather, afterwards, Fed Chair Jerome Powell, he really did signal that the Fed is ready to consider cutting rates, but they don't want to cut rates too early. Well, markets are waiting to see when will the Fed cut rates, and they have been anticipating that we could see Fed rate cuts as early as March. In fact, there was a 75% probability and an expectation in the markets that at this March meeting, the next meeting of the Fed at the end of March, that we would see the Fed cut rates. However, since all of this data has come out, this data is very strong, and the Fed does not need to worry about cutting rates, because cutting rates, the reason they're going to cut rates is to stimulate the economy and to help keep that job creation going. Well, if jobs are already through the roof and other economic data, consumer confidence, what we call PMI readings, uh, lots of initials, alphabet soup, doesn't matter. But all of these different economic indicators right now showing the economy is doing just fine. The Fed is expected to cut rates before the economy really starts to falter, because if they don't and there's a lag, they'll be behind the curve. But with things as strong as they are, that time is not yet. So that's kind of what's going on. So last week, rates improved through last Thursday after the Fed meeting, and then boom, on Friday, that jobs data came in super strong and we saw rates jump. So if you'd gotten a rate quote on Thursday and then you got that same quote on Friday, you might have noticed that it would be 0.125, or what we call an eighth of a point higher. Or by Monday, it was even worse. It was up to 0.25% higher. So if you'd gotten a rate quote on Wednesday or Thursday and you were looking at a house, but you hadn't locked in anything yet, you might have gotten an interest rate that was 0.25 point higher by Tuesday. Now, we have seen things improve a little bit since then. They've recovered a little bit on Tuesday. They've recovered a little bit this morning. So that's good. And we're not quite back where we were, but it is showing signs of recovery and things are stable. So these are small movements in interest rates, about 0.25%. But again, who wants to pay 0.25% higher than you were quoted just a couple of days before? Now, if you have time and you wait, my belief, and again, it's just a forecast and it's not worth the paper it's written on, people, but my forecast is I think things will get a little better, but we'll talk about that in a moment. Now, as far as VA rates, generally, you're going to find VA rates that are in the low to mid sixes. If you're being quoted in the low to mid sixes, that's very much on par with where we would be. Now, that's without paying points necessarily. That is what we call a par rate, or a rate that is quoted with either a very small fee or maybe even some credit back towards your closing costs. If for some reason you're not getting a VA mortgage, you'll find the conventional rates are generally in the low to mid sevens. And what's up, Mr. Nathan Einkorn? I see you live. Thank you, sir. You'll find that rates are generally in the low to mid sevens. If you're buying a conventional, what we call conventional mortgage, and you're buying your owner occupied home around now. So as far as the forecast and where we think things are going to go from here, over the next 15 days, rates could improve if next week we get a good inflation number. So next week on the 13th, which is Tuesday, it's basically a week from yesterday, we're going to get what they call the CPI inflation report. It's a consumer price index, and it's going to show, hey, do we see signs of continued cooling of inflation? Now, it's important to note, we don't see deflation. Deflation is when the price of goods drop. We're not seeing deflation. Things are still continuing to be expensive. We're seeing disinflation. It just means that they're not becoming more and more expensive as quickly as they were. The pace of inflation is coming down, and we want that to come down around 2%. So if we get a good reading next week, then hopefully that'll help mortgage rates to stabilize a little bit, maybe improve, maybe help bring us back down that 0.125 or 0.25, that 0.25%. So that's generally, we're going to be looking for that. Now, if that data doesn't come in advantageously, right? Let's say that data comes in showing inflation has increased. Well, that would be bad. That would push mortgage rates higher. And this is why you tend to see mortgage rates that move up and down. It's not because bankers get in a room together and decide how much they're going to charge that day. It's because of how things happen on the open market. All right. Now, over the next few weeks, rates aren't likely to go up too much higher. We've seen the worst behind us, October of 23 last year. Those were the worst rates that we were likely to see for quite a while. All right. Hopefully we don't revisit them again. But We're not likely to see rates move too much higher, but they could creep a little bit higher. We're going to need to see signs that the economy is slowing down and signs that the labor market is softening and signs that the Fed needs to start thinking about cutting rates either at their March meeting or their May meeting. Now, right now, let me go ahead and flop this around. Let's see, where is the, here we go. So right now, I'm going to show you guys a chart. This is what we call Fed futures. Right now, the expectation at that March meeting on March 20th, markets believe that there's about a 75% chance that the Fed is going to leave rates alone in that March meeting. Now, if something were to happen where we saw really great inflation data next week or some other signs of economic weakness, we would see this number get lower, and we would see this column go higher where we expect to see a rate cut. Again, the Fed can't cut mortgage rates, but the speculation, the expectation of what the Fed is going to do, it influences where our mortgage rates are. Now, as far as what markets really think, where do we really think we're going to see a rate cut? They're starting to price in May 1st as that one. So that's not the next meeting, but the meeting after. It's a few months away. Right now, markets believe that there's about a 75% chance that we'll see a rate cut by that meeting. Most of the probability is that it'll be the first cut. There's some people that hold out and think it could be a second cut. Actually, it's not 75, it's 65%. Sorry. So there's about a 65% expectation that we'll see a rate cut. Now, as we get into June, markets believe that there is almost no chance that we will be at the same Fed funds rate that we are today. Markets believe that the Fed will have to take a step by June, but that's a long way away. So as we see these chances improve, that's when we see mortgage rates go ahead and change and improve along the way as well. So with that said, let me get rid of this little thing so you can see my whole slide here. We'll actually pop it up here. Rates should move lower as we continue through 2024, but nowhere near those pandemic lows. So if you are currently out there and you are looking for a home, you can expect that mortgage rates are going to stay in the range that we've seen, generally in the lower sixes for VA mortgages, in the almost a full point higher of almost in the sevens for conventional mortgages. It's likely that we see that. If you are currently under contract and you have a mortgage in process and you're waiting to see when should I lock in this interest rate, well, there's always risk to floating. Risk is not too big this week, but if we're going to see any kind of improvement and you're going to see better pricing in the way of either a lower mortgage rate or better credit or lower costs to get a mortgage rate, you're going to have to wait and see what next week's inflation data brings and keep your fingers crossed that it is better, showing inflation has improved. So I'll be here next week to talk to you about that. As always, always appreciate y'all being here. Thank you so much. If you guys have any questions, remember, please go ahead and put them in the comments. I'll be glad to answer them for you if you do have any questions. Otherwise, I'm going to go ahead and wrap it up. Okay, someone said, please explain the cost of longer locks. But I can't see who that is. Do me a favor. What is your name, by the way, that put that in? So let me talk a little bit about what happens with a interest rate when you lock it. All right. So everyone thinks when, if I'm a consumer, and I'm sorry, I should actually pull up my Remarkable and draw this out. It would be a little bit smoother for you, but we'll have to do this verbally, right? As a consumer, you will have an option when you have found a property. You have to have a property. A lock has to be on a particular property. You can't just lock an interest rate and shop, at least not generally. There's a couple of gimmicky programs out there called lock and shop programs, but overall, you need to find a property. Once you have a property and you are under contract on that property and your mortgage is in process, you'll have the opportunity to lock in an interest rate. When you lock that interest rate, you're protecting yourself from rates getting any worse, but you're also limiting yourself in case they get better. Some people choose to float, meaning they have not locked in their rate and they're subject to the market conditions. And at certain times, you're just going to want to go ahead and lock. And it depends on your risk tolerance, what's going on in the market, what are the chances things are going to get worse or improve. But ultimately, you can get the conversation with your mortgage professional to give you some insight, but it's your decision as a consumer. Now, there are benefits to floating until as you get closer to the end of the transaction. And we have what we call lock windows. All right, Mr. Teakle, thank you. I thought that sounded like an LO question more than a consumer question. So you have what we call different lock windows. And when you lock in an interest rate, you are locking in a guarantee, and the lender, the bank, has to take on more risk that things may move between when you lock in your interest rate and when you close your loan. In order to hedge against those risks, there's increased costs to your lock. So you may find as a consumer that you can get a slight improvement to your pricing, to your interest rate itself, or maybe the cost of that interest rate by waiting and locking in for a smaller window. Generally, they go in 15-day increments. So there's 15 days, there's 15 to 30 days, 30 to 45 days, 45 to 60 days. And the longer the window, the more expensive. So you may get a slightly higher interest rate, or you may have slightly worse fees for locking in a longer window. But depending on your risk tolerance, that's okay. It's not a bad decision. Again, best that you have that conversation with your mortgage professional to figure out what's right for you. But that's how that works. You decide, hey, how much do I want to see? And a lot of times, your mortgage company may not even bring that to your attention, that there's these small variations, because it's just part of that overall cost that they present to you as things move each and every day. So you can ask them if there is any lock window costs associated with that for a longer lock period. But generally, the longer that you lock, you're going to get a slightly worse fee because the lender is hedging the way that goes. So thank you, Mr. Tinkle, for asking that question so we can point that out to everybody. Love to be able to do that. I will have my Remarkable ready to share with you guys some questions next time. So, all right, my friends. Well, thank you so much for joining me. I appreciate you being here. Remember, we do this each and every week. You can find out more about us here at on Wednesdays, what's going on with the mortgage rate market. You can join us at 12 p.m. Eastern time, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. And we'll see you next week. Take care, everybody, and make it a fantastic one. Bye-bye.